The following content is an update and technical analysis on crude oil, West Texas Intermediate futures based upon the daily interval, where I will additionally be deep diving into the 240-minute interval, as well as the much larger picture within the monthly time frame. While oil prices continued their 4-day descent here, with reaching really a 5-month low, where the drop has been contributed to surging U.S. oil exports, reaching record highs, coupled with a flood of domestic crude production just saturating the market, where Saudi Arabia's assurances of OPEC Plus to production cuts have just completely been overshadowed, where non-OPEC nations, including the U.S., Brazil, Guyana, are pivotal within the oil production surge, contributing 1.4 million barrels a day and adding only to the supply concerns is China's economic uncertainties that are completely dampening the demand outlook for crude oil, where discretionary driving is on the decline, with people struggling to afford and commute to work. This marks the most significant crude oil build since 2020, when the entire global economy was completely locked down amid a global recession. And I believe we've come across a very peculiar juncture within the daily time interval within this primary reactionary upturn line based upon the March reactionary lows. And this has been a key significant inflection point where we actually caught a pretty well-defined big bounce to the upside, especially if you're an active and or day trader. Back tested off the 618 Fibbs retracement, had a pullback-like reaction and overshot the 618 Fibbs retracement, coinciding with the 200-day moving average. That was good for a 10.2% rip to the upside, double digits. And here we are, completely overshooting that inflection point, dual line of resistance on a false breakout. And it has been nothing but selling since. And here we are, completely cracking the primary reactionary uptrend line and the 72.70 price support there, which now has become resistance, coinciding with the 73.08, 786 Fibbs retracement. Whereas long traders need to really recover these multiple triple line of inflection points to spur any health back into the trade, as far as any whipsaw-like reaction and a move right back into the primary reactionary uptrend line, in my opinion, would offer an aggressive risk-reward ratio short trade setup to the downside, which you would call oversold conditions within that juncture for a prolonged move, potentially right back down to the 70.09 price support. And additionally, if we take that level out, move on in what I would call the 50 monthly moving average to retest if there's any shot at any sort of whipsaw-like reaction and or false bear trap. This could be the juncture right around this range, around the $69 a barrel range. So for a move, an aggressive short trade setup and upon that inflection point would be good for a 6.2% crash to the downside, ultimately reflecting onto that third target, which is the 66.89 price support correlation with the monthly interval for an 8.3% crash, down to the 63.95, an additional monthly major price support there for a 12.3% crash. And upon zooming you in to the 240-minute interval, and here we are trading amongst the zero-line Fibbs retracement, where we had that additional reactionary low. We had that nice, clean, positive divergences upon multiple, all 4 technical momentum indicators, which was the catalyst for this technically induced move for double digits to the upside, tagging the 382.7904 price resistance, only to be rejected very impulsively throughout that entire inflection point. If we bounce here, based upon the 72.31 price support, we will undoubtedly put in potential exaggerated near-term positive divergences on multiple time indicators, in which would be a very bullish sign for a great snapback and or counter-trend rally for a great risk-reward ratio short with long trade setup to the upside, targeting the 75.31 price resistance and the 200 in correlation of the 240.50 moving average, calling an extremely aggressive long trade entry going against the fundamental catalysts that have ensued. And upon zooming you out to the much larger picture within the monthly time frame, and what I see here is a potential head and shoulder classic looking top with big 50-month moving average support down below across that 69 threshold, and exactly why I would remain around the 69.13, which could result in a bear trap where we could peel right through that support level, potentially bounce right through it, and only to be rejected upon that move to the downside in a false bear trap whipsaw-like reaction, undercutting the 70.09 price support. Upon taking you back out to the monthly, the 66.89 price support will be the biggest inflection point in quite some time. Call it a multi-decade of price resistance, cuts through a series of wicks, reactionary highs, and major reactionary lows, really across the board there, all the way going back since 2005. And if there was any odds that were being raised for a bounce, it would be across these inflection points, coinciding with the 63.95 price support, additional reactionary lows, really across the board. Call it multi-decade price support level. And that would be the most geared inflection point. If we take these levels out, there will be chaos within the Middle East and a huge demand rug pull if and when we come across these junctures. And then ultimately 54.76 price support down below, which would be an ultimate big play big move to the upside with the most valuable long trade setup, bigger move to the upside if and when we come across any of these key inflection points, offering a great risk reward long trade setup to the upside. We are slightly undercutting the 73.32 200 monthly moving average. So again, if you wanted to take that long trade setup, which would be an exceedingly aggressive one in my opinion, right off the zero Fibbs retracement in correlation of the 200 monthly moving average, do not underestimate how quickly things can change to the downside and how violent a crude oil sell-off could continue to build under the scrutiny of a much larger, unanticipated, full-blown recession.